Now it's my pleasure to introduce our presenter for today, Stephen White. Stephen White is the managing partner and founder of Onyx Partners Group. Prior to founding OPG, Mr. White spent over 25 years working in the financial industry in areas of investment banking, private banking, and most recently in wealth management. Over those years, Mr. White crafted his skills by working with a variety of client companies and industries. He's worked with family offices and hundreds of private and family-owned business over his extensive financial career, providing top-notch services in areas of business acquisitions and sales, establishing buy-sell agreements for business owners, and offering valuable advice on how to navigate through the process of establishing an ESOP. Mr.
Right.
Is that good enough? I can go on.
No, that's
I can
enough.
go on a lot, but we better turn the time over to you, or you're not going to get a chance to put a word in. So
Just
I'll
made a
turn it over.
mental note to make an adjustment to this. It's way too long. Colin, I appreciate it. Thank you very much. And welcome everyone to day 3, hump day, right in the middle of the week here. And because I am who I am, I'm a little selfish. And I will say, I know that you've had 2 days of business valuation classes, but today is going to be the best of the 3 so far. So we're going to go over the topic. And I know that just to go backwards, now you did an introductory of business valuation to a degree. You talked about a couple of the other approaches. But today we're going to really focus on a particular approach that from our perspective, meaning Onyx Partners Group, which is the approach that we utilize a lot. And I'll explain to you how we use it, when we use it as we go throughout the presentation. I'll try to make this as more of a sharing realistic situations that we apply, how we apply the income approach in our daily activities, as well as some academic theories that go along with it as well. And on the idea of more the academic side of it, if you take a moment, you think about this, think about when someone is actually buying a company, or better yet, they're buying an interest in a particular company. Think to yourself this: what exactly are they really buying? Are they buying the management? Are they buying the markets? Are they buying the technical skills? Are they buying the products? Think about it. What exactly is an investor actually buying? Now, each one of those factors that I just mentioned, the management, the technology skills, the markets, the products, they all could play an integral role in as far as that investment decision. But what is actually being bought is that you're buying a stream of prospective economic income. And that's what we're going to talk about today when we go through the income approach. So the income approach has the underlying theory, which is discussing the benefit stream, and the required return, which will either utilize a discount rate of the capitalization rate or the discount rate. And we acquire this through 2 different primary methods utilizing the income, either the single period capitalization or the multi-period discounted cash flow, which is actually known as the DCF. So to create value, one must obviously increase what I like to refer to as the numerator, and you reduce the denominator, or you reduce both of them. So when, by definition of value, you apply it to the investment, and it takes the following turn. You have your cash flow, which is your benefits. So as we talked about the underlying theory, this is your benefit stream here, and you are looking forward. So past performance is only considered as an indication of the potential for future performance, which makes sense. I know you've all heard that terminology before, but the denominator captures what is referred to as the time value of money, as well as the perceived risk or the volatility of that particular investment, because it's the inherent of the cash flows. So the risk is a function of the investment, and it is not of the investor. So this will make a lot more sense as we move along, but just keep that in mind, that your cash flows is actually the benefit, and the perceived risk, which is in the denominator, that is what is considered as a risk function of the investment, of the time value of your money. So the underlying premise of the income approach is that it assumes that all assets, tangible as well as intangibles, are indistinguishable parts of the business, and it does not attempt to separate the values of the two. So the value in a business is based on the future estimate of earnings to be generated by the company. So remember what I said, and also the critical component of value of a business is its earnings or cash flow. So remember I asked you, what exactly are you buying when you buy in a company or part of the company? You buying the manager, you buying the product, or you buying technology? You're actually buying the benefit stream. So the numerator, as we've discussed before, you have your expected benefit. And this is the formula for essence of value. You have your expected benefit, and in the numerator and the denominator, you have the required return. The benefit is forward-looking, and then your required return embodies the risk of the time value of money. So essentially, this is the amount of risk that someone is going to accept, or the amount of risk they will accept for the time period that their money is in that particular investment. So the essence of value is the expectations of the future. So getting more specific into the essence of valuation, you break a company into two different components. You either look at it as a whole, or you look at it just from the equity standpoint. From a whole perspective, you have your enterprise value. So when you're measuring the company value, essentially. So the numerator captures the benefit to be generated for all the capital providers. So you have the net cash flows to the invested capital, or the net cash flows to the equity holder. And the denominator, in this instance here, is that it captures the return of the required by each capital provider to the investment or the buyer. So what you see here is the weighted average cost of capital, which is the required rate of return. So the weighted average cost of capital is resulting in company value, which involves the market value of the debt plus the market value of the equity. And this is an important distinction when you're valuing a company, because one has to be very clear as to what is actually being estimated. So when you're valuing the equity value, you have your net cash flow to equity holder over the denominator of the required rate of return. And what makes the distinct difference between the two is that as you look at the enterprise value, the total investment capital, the entire company, you have market value of the debt plus the market value of the equity. So this relationship must hold true, because in order to have the total invested capital, you subtract out the net debt, and net debt calculation is debt minus cash. That equals the market value of the equity. So if you just take out the debt, then you have the equity. And so just to give you more of a visual, or more of seeing this overall idea, let's take a look at the first part of this slide. This represents the entire company. So this is present value of cash flows to the total invested capital. And this is what's referred to as your enterprise value. To your right, you notice two different shades of color. You have green and you have blue. The green represents the debt value, and the blue represents the equity value. So you have present value of cash flows to the debt holders, and then you have present value of cash flows to the equity holders. And what's included in that, obviously, are your common stock, your preferred stock, and any minority interest that you may have. So the enterprise value equals total invested capital. And I think probably the best way of viewing this, or having a better understanding if it's still not very clear, it's just like when you purchase a home. You buy a home and you have a mortgage. You own the home, you own the mortgage, all of this is included. This is your home right here. Now, when you receive your first statement after a couple of years, maybe some of you live in a particular area where it shows very quickly, but let's just say after a year of making monthly payments, you pay into that mortgage and you're reducing mortgages as your debt. But anything above that, what you actually paid for it, or whatever your mortgage, that is the equity that you've built up in this particular home. And the equity also could be the market value, can enhance the value of your equity as well versus what you actually bought it for. So when I'm having a conversation with clients, when we're walking through, just trying to have an understanding, when we're explaining to them the approach that we utilize and trying to explain what are we actually valuing? Are we valuing the equity of the business, or we're valuing the debt value of the business? Or, I mean, not just the debt value of the business, but including the debt value. We break down that example of acquiring a home and owning a home and how that translates over to the income approach. So determining the appropriate benefit stream. Couple of things to keep in mind as the benefit stream, because it is an integral part of the income approach. You have your earnings versus your cash flow. You have a normalized level, measures of economic income, and proxies that you can utilize for cash flow are things that you probably are very well familiar with. But if you're not, I'll explain what they are: EBIT, EBITDA. And when you're speaking to a client or speaking to someone who's not really into the finance lingo or jargon, I should say, it's always good to just explain exactly what these acronyms stand for. So EBIT is earnings before interest and taxes. EBITDA is earnings before interest, taxes, depreciation, and amortization. Then you have free cash flow, which is a extremely important part of any particular business. Understanding what is their free cash flow. You have seller's discretionary earnings, SDE, and operating cash flow. But you also have the interest being valued. As we talked about, the equity value versus the enterprise value, the net cash flow to equity and the net cash flow to invested capital. But before you can value any company, you need to make sure, calculate your discount. You want to make sure that you're applying it to the appropriate benefit stream. So you have a benefit stream for historical income and a benefit stream for projected income. For your historical income, this indicator gives you an indication of expected future benefits, and it's also considered to be a good proxy for the future, and it's based off of a linear benefit stream. And oftentimes the companies that we deal with, especially, and this is not to say that all companies fall into this, we run into a lot of manufacturing companies that have a very linear benefit stream. So we utilize oftentimes their historical income because it's a great proxy for us as determining the future results of the company. But there are often times that we run across companies that have their earnings, their benefit stream is probably going to be like this. So those are more of your non-linear benefit streams, and you provide a year-by-year forecasting. That instance, you're utilizing a discounted cash flow. So let's define net cash flows. So we have invested capital, which we talked about a little earlier, and then we also have equity. Remember, in invested capital, we're looking at the total company, the equity along with the debt. And the equity side, purely just equity as it states. So we start with the net cash flow to invested capital equals your net income plus your non-cash expenses plus your interest, and that's the interest from your debt minus the taxes. That equals your gross cash flow. But you're not done there, because then you have to add in or subtract out your changes in your net working capital. You add in or take out your CapEx, which gives you your discount rate for the weighted, applies your your weighted average cost of capital, Now from equity, it starts off in the exact same way. You have your net income plus your non-cash expenses, which equals your gross cash flow. So here's the difference between the two, is that you do not have your interest. You don't have to add in your interest minus your taxes. You have your net income, your non-cash expenses, which equals your gross cash flow. Again, you want to add in or subtract out your changes in your net working capital, add in or subtract your CapEx. But here's the difference between net cash flow to invested capital versus net cash flow to equity. Net cash flows to equity, you would add in or change or take out the changes that are applied to long-term debt. And that's only if it's reoccurring. Oftentimes you'll run across things where you'll see a long-term debt and it's there for like 1 year, 1 or 2 years, and they paid it off. So it's not something that you would automatically apply there. That's something that, like I said, it has to be on a reoccurring basis. So forecasting CapEx and working capital. So keep in mind There are a couple of things with forecasting. Forecasting is one of the areas that we try to focus on. And one of the things that I was taught years ago working in investment banking, whenever we're doing forecasting, and I apply this to what we do right now in evaluations, is that not only is your forecasting needs to be realistic, it also needs to be sustainable. And so it's realistic and it's also sustainable for the company itself. Because you can sit there and you can have conversation with clients often, and they will give you their projections of what they strongly believe the company will perform over the next 3 to 5 or 7 years. And truthfully, sometimes they're right. And sometimes you sit there and you shake your head and you're trying to figure out what in the world you're talking about. We have a company that we valued 2 years ago, and I use this every time because it's a great example where we sat down and we did the valuation for them. We were in the process of doing the valuation for them. We were doing our management meeting, sitting down, discussing forecasting and the projections. And immediately they just came out of the block and said, we're anticipating returns of 14 to 17% return over the next 5 years. We looked at each other. I had a partner with him. We looked at each other and we looked back over at them and said, okay, really? 14, 17%? That's great. Meanwhile, keep in mind, this is a company that had only been showing returns of probably anywhere like 5 to 7% over the last 5 years. So they've gone from 5 to 7% to 14 to 17%. That's a huge jump. So you want to have a conversation and try to completely understand how is it that you've gone from single digits to double digits and returns that you're forecasting over the next 5 years. Oftentimes, stuff like that really doesn't happen. The truth of the matter is, this company did actually hit those numbers. They actually surpassed those numbers. And we found out during our due diligence while we were sitting there is that they had a new product as well as a company that they had planned on acquiring that helped them grow their revenue. The first 2 years they did not hit those numbers, but the next 3 years they ended up. So I said 2 years, so it's been about 4 years now. Wow, time goes by very fast, where they're actually hitting those numbers and still working extremely well. So the point of all of this is that forecasting your capex and your working capital, it must be projected over a forecast period to determine the long-term level of sustainable growth. So remember to integrate a new depreciation estimate into that income statement forecast, because the changes in the net working capital are calculated different between each period. So determining the required rate of return. So you have a capitalization rate along with what's called a discount rate. And this is a rate of return, or that is referred to as a yield, necessary to attract the capital to an investment relative to the level of risk of inherent in that particular investment. So remember, we were discussing the denominator. This is the amount of risk that someone is willing to invest into or absorb in making an investment into this particular company. So your capitalization rate, your discount rate, this is that number that you've calculated is what's going to be helpful in attracting more investors or attractive to people to acquire your particular company. So determining the required rate of return, as I mentioned, you have your capitalization rate, which is used to convert a defined stream of income to the present value. And you provide this through a single period method. And then you have a discount rate, which is used to convert a series of future income amounts to their present value over a multi-period. We often use the capitalization rate on a number of our valuations, but we also utilize the discount rate as well. And it just depends. It depends on the company that you're actually working on, as well as it depends sometimes on the industry as well. Or not necessarily the industry, but the purpose of the valuation. So subtracting the company's long-term sustainable growth rate from its discount rate derives the capitalization rate. So as you can view from this formula here, you have the discount rate minus the industry's long-term growth rate will ultimately give you your capitalization rate. So how do you determine the discount rate or the capitalization rate? How is that all calculated? Well, there's different methods that a valuation analyst use to determine the discount rate. One is your cost of equity, required return to equity holders. You can use the Dolphin-Phelps build-up methods, and I think in your notes it may still read Ibbotson or Morningstar. So years ago, it used to be Morningstar would provide this data for you, and then Morningstar was acquired by Ibbotson. And then Ibbotson was actually, there's SPVI in there as well, but then Dolphin-Phelps now owns everything, so it all falls underneath them. So you may still refer to it as Ibbotson. People have been in the business for a very long time, they'll know exactly what you're referring to, but it's also is more known now as the Dolphin-Phelps build-up method. And then for those of you that have a finance background, such as myself, you'll be familiar with capital asset pricing model, CAPM, which is another means of determining your discount rate, much different than the Dolphin-Phelps build-up method. And it depends on, you'll hear me say depends a lot. You probably heard it quite a bit on Monday and Tuesdays as well. But it depends on what you're valuing and the audience that you're actually speaking to, because some will argue that that CAPM is a more effective discount rate than utilizing the Dolphin-Phelps, and then you'll have some that will argue the exact opposite, because of the mere fact that Dolphin-Phelps gives a little bit more subjectivity to the analyst than utilizing the capital asset pricing model, which is tied to the market and the beta. Then you also use the cash flows to equity holders. Second is, and it's time for our very first polling question, because I want to make sure everyone gets their CE credit. So make sure that you check off on your polling question there. So the second method to determine the discount rate is the weighted average cost of capital. So we talked about this a little, the WACC, right? So this reflects a required return to all investors, the debt and the equity. So before we were just referring to equity. Now we're, as pertaining to the weighted average cost of capital, you're incorporating debt. So it includes cost of equity and the cost of debt, required return to the debt holders. And you use the cash flows to invest the capital or the free cash flow to the firm. And again, you'll see free cash flow appear a few times throughout the course of this day, and as well as probably for the remainder of this week as well, because for me personally, I think free cash flow is a significant part of the valuation. As your free cash flow increases, or the larger your free cash flow is, the larger your multiple, the larger your company. So let's take a look at the discount rates utilizing the Dolphin-Phelps build-up method. So you have cost of equity, and you have our formula RF plus ERP plus IRP plus SP plus SRC. And they are identified as RF as your risk-free rate of return. Your risk-free rate of return is identified by utilizing a risk-free rate treasury bill. Okay. Your equity risk premium, which makes sense, is the equity risk, and it's normally tied to the S&P 500. Industry risk premium, which is tied to your specific industry. Your size premium, which is denoted by the size of your company. You have large companies, mid-sized companies, small companies. And then you have the all ever so controversial small company-specific risk, identifying what risk that this company has applies specifically to that company. So how do you come up with that particular risk? That's a great question that I often get. And it really comes down to, and again, it's the subjectivity of that analyst by working with the management team, because that's, in my opinion, that's the only way that you're actually really coming up with a company-specific risk. So let's take a look at an example here of utilizing the Dolphin-Phelps build-up worksheet. So if you recall, let's see, RE is a company is founded using the build-up method. In this case of Ibbotson build-up method, one formula for the build-up method is, and we walked you through what the formula is. So let's take a look at the background here. We have a subject company, has $42 million in sales. Good size company. The company has 20 million in total assets. Sales growth has been steady over the last 5 years. Management is experienced. Company is well financed, and the company is one of many competitors, but has a strong market position. Those are always good companies to value. Something like that is very straightforward, very clean. So calculating out the Delfenfeld build-up worksheet, remember we had the risk-free rate, the equity risk premium, small size premium. So we need to fill in the blanks and filling out what they all represent or what they're tied to. So the risk-free is a 20-year treasury bond rate as of the valuation date. And for this example, is 4.4. The equity risk premium, which is intermediate S&P 500, is 7.8. Your small size premium is 3.3 for the size of the company. The industry risk premium is 2.0. And for this example, the specific company adjustment is 3.0. In order to calculate the total risk premium, you would add your equity risk premium, your small size premium, your industry risk premium, and your specific company adjustment. So that's 2 plus 3, 4, and 5. That equates out to your risk premium of 16.1. But you're not done there, because remember you have your risk-free rate. So you add the risk-free rate to your total risk premium, and that gives you a total expected return on your equity. So that's adding line number 1, which is your risk-free rate, obviously, and your total risk premium gives you a total expected return on your equity of 20.5. So you should be saying to yourself, Stephen, where do you get all these numbers from? Or is the subjectivity of an analyst, they just kind of know that these are where the numbers come from? Well, actually, no, they do not. 2 years ago, there used to be a book that you could actually pull off the shelf to estimate the cost of capital. I still personally like to use the books, and if there was a way to show you, in this, well, not that bookshelf, I have another bookshelf on the other side of the office that has my old books that I still go back to from time to time to review and pull those variables estimating the cost of capital. But for the example that we just utilized, we have this tier sheet here. As you can see, it still has SBI Valuation Edition 2002, Iverson Associates. So the risk-free rate. So for the risk-free rate, remember that we utilized, just going back, we used the 20-year T-bond rate as a valuation date. But here's what's interesting about this, is that the risk-free rate and equity risk premium should be tied together. And the reason for that is the value of the equity risk premium also includes a risk-free rate. So if you're dealing, whatever time frame you're using, long-term, intermediate, short-term, that has to equate to your risk-free rate. So your equity risk premium is intermediate. So therefore, in reality, your tax-free rate should also be intermediate. So we can see here we have yields for the riskless rates. We have the long-term, 20-year, which is at 5.8, but we also have the intermediate term 5-year. So in actuality, this should be the 20-year, should be the intermediate T-bond, just for example here. I have to make a correction there, of 4.4%. You drop down to the equity risk premium. We're utilizing an intermediate horizon expected risk premium of 7.8. Size premium, because it is a 42 million in sales, size 29 million in assets. Microcapitalization equity risk premium of 3.3. And again, as I mentioned to you, the specific company adjustment is coming from the analyst himself or herself after interviewing and meeting with management, understand the industry, understand the company in order to calculate their company specific risk, and they calculate it at 3.0. But your equity risk, your risk premium, equity risk, your small size premium, industry risk premium, you are able to retrieve those variables for estimating cost of capital right from this particular sheet, in which analysts used to use all the time. Now everything's web-based. You can go to Dolphin Phelps, and there's a calculator that they actually have. BVR actually has a calculator also to help you with the cost of capital. So there's a number of different things that you have. I actually like to still walk through and work through the calculations on my own, and because here's the reason why. If you're ever in a situation and you're ever being challenged as far as how those calculations or where those numbers came from, you want to know exactly where they came from. It's great, it's efficient, and it's very clean to utilize the web base and just put in a couple of numbers and voila, your cost of capital is there. It's great, but it's also good to understand how those numbers are calculated. So therefore, they do not print the book any longer. Everything is web-based, much like a lot of stuff now is going web-based. But it's just good for you as a evaluator to understand exactly how the build-up method is calculating, where all those numbers derive from. So equity risk premium. Let's take a look at the Dolphin Phelps data. So this is another source of equity risk premiums, ERP, which is used in calculating the cost of equity. It examines the historical equity risk premium relative to the company's size, and it's also based off of 8 measures and the risk in 3 different measures. Size takes a part in this is 25 size rank portfolios, and it incorporates the size premium directly into the equity risk size adjusted. So when we go back to the build-up method, you have the cost of equity, risk-free rate, the equity risk premium estimate plus the size premium, and then you have equals the RPU equals the risk premium attributed to a specific company or to the industry unsystematic risk or the company's specific risk premium. Now, there are other types of small business build-up models as well. It's not just the Dolphin Phelps model. So there are others that are there. You have the Schlitz risk premium guidelines. You have the risk rate component model, which you can actually do on the Dolphin Phelps cost of capital calculator. You have the Jeff Jones method, which is development of a pricing multiple. And you also have black-green build-up summation method. And we utilized that one quite a bit when I was an undergrad. Here's the great thing about knowing these, and I'm not suggesting that you should have all of these in your repertoire when you're doing evaluation. It's always just good to read up on them and know them. You're going to run across probably, if you're ever comparing or working on a valuation, you're more than likely you're going to be utilizing the build-up method for the most part. It is a very popular method for calculating the discount rate. It's not the only one. As you can see, there's different ways to do the build-up models than the Dolphin Phelps. But the point of all this is that it's always good to know what other evaluators are doing, because if you're ever in a litigation case and they're using one of these build-up models, it's always good to have a clear understanding of exactly how that is calculated and how that discount rate was applied from utilizing these. And also, the question is, well, if you have all these different build-up models, you're going to all of them going to calculate the same discount rate? No, not at all. It's not. And it depends on what your situation is, the type of company in the industry, on which you determine which build-up model works best. Some will argue that the risk rate component model is appropriate for X type company, where others will say the black-green build-up summation method, it applies to everything across the board. You're going to get arguments either way, but it's just good for you as an evaluator just to be familiar with each one, know that they do exist, and if you have time to study on them more, you most certainly can. But like I said, the risk-free rate component model, you'll probably see a little more than the others here. So let's talk about the capital asset pricing model, CAPM. So CAPM pricing model is derived from the Martin portfolio theory, and it is founded on a number of basic premises. First thing is, investors are what? Risk averse. Capital markets are perfect. There's an unlimited access to freely available transaction costs. They're ignored. Investors' portfolio are well diversified, and there's a component of risk, systematic risk, which cannot be diversified, such as the state of the economy. So just based off of this information that I just shared with you, there's a distinct difference between the build-up method versus utilizing CAPM. And it's all tied to the market, right? Whereas the build-up method, obviously you have subjectivity from the analyst in order to come up with the discount rate. So with the CAPM model, CAPM, you have your expected return on the security, you have your risk-free rate, you have the beta of the security, which is the amount of risk, volatility of the market, I should say, and the expected risk premium of the market, which is the formula. But there's also something that's called a modified CAPM. So you have the cost of equity, the risk-free rate, equity risk premium, you have the size premium, and the company-specific risk. So I mentioned beta, and we have our second polling question. So I'll give you a moment to check off on that. Okay, so we talked about CAPM and the differences between the build-up method and CAPM, but we talked about what is beta. So let's go back just for a moment. Let's take a look at this particular formula. So you have your expected return on the security, you have your risk-free rate, and the risk-free rate is also the same thing that you have in the build-up method. So whatever, just go back here. Whatever your risk-free rate that you're tying into your equity risk premium is going to be the same from the build-up method as well as in the CAPM. But here's where the difference lies. It's understanding the volatility of the overall market. That is an integral part of the CAPM. So beta is a factor used to measure what's called the systematic risk. So remember, this is things that is undiversifiable with the economy itself. So systematic risk is the uncertainty of future returns owing to the sensitivity of the return on the subject investments to the movements in the returns of the composite measure of marketable investments. So how do you calculate? How is that determined? Well, it's determined by the measures of level risk related to the overall market. So if you have 1.0 or more, it's more volatile than the market. If it's less than 1, then it's less volatile than the market. But if it's equal to 1, it's less than, it's equal to the market. So you're either more volatile, less volatile, or you're right in line with the market. And the best way probably to visualize this is take a look at this chart on the volatility relative to the S&P 500 index. So we have two different companies here, and along with the S&P 500 index. And this was a chart that was done back in 2009. And it still holds true to today of how the beta works. So it's a great example, even though it was back in 2009, it's still a great example to use. So we have Intel, which is a technology company, and American Electric Power. So Intel is the red line here. And American Power Electric is identified as the green line. And we're utilizing the Goldman Sachs as the index here. So as you can see, that Intel's beta is 1.28, because if this is the market, you can see that it's more volatile. And American Power is equal to 0.62, which is below 1, which the market is here. And as you can see, this is American Power. So it's less volatile than the overall market. So depending on the beta that you actually have, as we go back, we'll change the conversation as far as your discount rate, depending on the company that you're working on and the industry that they're actually working on as well, will determine the beta, which will change the calculation of the of the capital asset pricing model. So academic studies which have compiled the beta industry, you look into guideline public company comparables, publicly traded companies within the same industry or as well as the same subject company. You have published betas are typically levered betas, may need to unlever or to make comparable, and then you have average comparable betas as well. So the weighted average cost of capital, we talked about this very briefly, and I'm going to go back a couple of slides because I want to make sure that, because we talked about the build-up method, and we kind of jumped around and we talked about the weighted average cost of capital as far as calculating the discount or your capitalization rate. And these are different methods that you would utilize. So to use the weighted average cost of capital, remember that it reflected the required return of all investors, the debt as well as the equity. And it also includes the cost of equity and the cost of debt, which gives you the required return on the debt holders. And then use the cash flows from invested capital, your free cash flow of the firm. So that's explaining to you what is WACC and when you would use it. And if you recall, when we were discussing the net cash flow, you were adding the debt and the net cash flow to invested capital equation. So let's get back to my slide here. So the weighted average cost of capital, and I won't go through reading each one of the problems that make up the formula for weighted average cost of capital, but just understand that there's relative weights of debt as well as equity derived from the examination of the industry. So the cost of equity is derived from the buildup or the CAPM method. So you still have, the WACC is not a standalone. You derive that information. You still need the cost of equity, as you can see here. And the cost of equity is calculated from either utilizing the build-up method, or those of you who feel more comfortable dealing with something that's tied more into the market, so you utilize the CAPM in order to calculate the cost of equity. Once you calculate the cost of equity, you plug that into this particular formula in order for you to calculate the weighted average cost of capital. Has nothing to do with debt. The debt comes in afterwards, but you would utilize the cost of equity first, calculate that part of it first before you can move on and calculate the weighted average cost of capital. So how do you calculate debt? So the cost of debt, you have comparable company analysis, and you would like to examine the filings of comparable public companies for average rates. You have industry analysis, average debt equity ratios within the industry. You have discussions with bankers to interview bankers to provide quick assessments to approximate rate. And you have transaction value used to post-transaction capital structure, cost of debt of the acquirer. For me, I like to work with the bankers. Now, I think also industry analysis is a great resource for you to use in order to determine the cost of debt. But for me, I think working with the bankers, it does a couple of things. One, you're there. You're interviewing the bankers to provide the quick assessment and the appropriate rate. But you're also developing a relationship with them as well. Who deals with a lot of transactions? Bankers do for the most part. And if you're coming to them most of the times, and I worked with investment bankers when I first came out of college. That was my first job, working for an investment bank out in California. One thing that they enjoy talking about themselves and knowing that they are being used as a resource. And once you have them in that particular position where they enjoy knowing that you're kind of like their go-to person, if you need something, come to them, they'll be there with the answers. Well, they also know that when certain deals are on their plate and they're looking for someone to help them with the valuation of this because they're in like mindset of at least that's what they're thinking, they're going to reach out to you, which is what typically happen along with us, is that we have a great relationship with a number of different bankers, and we have a lot of business that comes from that way. That doesn't mean that the others aren't great resources as well. That's just something that I leverage on, and I pass that on to our team as well to leverage off of as well. In fact, one of our members is a former investment banker. But industry analysis is always a great resource to go with. Comparable company analysis and also transaction value. Depending on the company, the size of the company, if there aren't a lot of transactions in that particular the company size that you're actually working on in that particular industry, that may not necessarily be the best use to help you with the cost of debt. But I would definitely say these two, in my opinion, are your top two, and then a comparable company analysis as well. Kind of falls into the transaction value to a degree, because if you think about it, the company comparable analysis examines the 10Ks of comparable companies for the cost of debt proxy. And you have your credit ratings, so you use the S&P or the Moody's credit ratings or S&P ratings to determine rough credit ratings and examine the cost of public debt versus ratings, right? And then you have transaction value. So you want to use post-transaction capital structure and cost of debt to acquire. So it depends on the size of the company that you're actually working on, which would determine which one would be a better fit, the industry analysis versus the discussion with the bankers. All right, so let's talk about calculating the weightings. All right, so you have industry analysis is what you're going to use. So you have the average debt of equity, average debt over equity ratios within the industry to convert to a capital structure percentage. And just to walk through this particular example, you have the average debt over equity ratio, let's say is 1.2x. So therefore your debt to total capital equals debt to equity ratio divided by 1 plus debt to equity ratio. So to plug in the 1.2, so you have the debt to equity ratio of 1.2 is divided by 1 plus the debt to equity ratio of 1.2. And if our math is correct without me doing this, it's 5.4.5. So if your debt to total capital equals 5.5, therefore your equity to total capital is what? The remaining portion of it, 45.5. It's pretty straightforward math. So remember from our house example, we had two shades of color. I believe the debt was green and the equity was blue, right? So this is your debt. This is your equity here. Or this is equity to total capital is 45, and this is your debt to total capital is 54.5. So the weighted average cost of capital, the WACC, we'll just call it the WACC, is the appropriate discount rate for which one? Equity? No. Invested capital, and the net invested capital net cash flow. So let's break down what each of these runs mean. You have the percentage of D, which is the percentage of debt in the industry capital structure. RD represents the market cost of debt, the interest rate. T is the effective marginal tax rate. Percentage of E is the percentage of equity in the industry capital structure. And RE represents the equity discount rate. So let's plug in these numbers for this formula here to calculate the WACC. So one, we need the percent interest-bearing debt. This is 54.5. So if we go back one slide, this is your debt to total capital is 54.5. We have the rate on the long-term debt of 5%. Our tax rate for this example is at 33%. Of equity, go back, is 45.5. And then your expected return on equity is 20.6. So the rate on the long-term debt is obtained from the industry or your guideline company average. So it's not where you would go to your Everson or Morningstar. This is taken from your industry or your guideline company average. That's where your industry average, and I think that's what we were using in the very beginning of this particular example, but you also obtain that also from your bankers that you may interview as well. So step 6, in order to calculate the WACC, you take 1 times 2, 54.5 times 5 times 1 minus 3, which is your tax rate, and 4, your equity, which is your 4.5 times your expected return on equity, or 20.6. This gives you a calculation of 15.9, which represents your WACC, the weighted average cost of capital. Hopefully that makes a whole lot of sense. I know that there's plugging in different formulas sometimes and trying to figure out, okay, so where are all these numbers coming from? It can be a little confusing at times, but it's after a while you walk through the worksheets, it comes to be pretty straightforward on knowing exactly if you're utilizing the industry analysis, or if you're utilizing discussions with bankers to obtain that information, or comparable company analysis, just being very careful on how you utilize those, as well as transaction value. Plugging in these numbers is not as challenging. So we have one more poll here. Give you a moment to answer that. Okay, great. So plugging in those numbers is not as a daunting position now. Now, keep in mind, there's a lot of softwares now that automatically plugs their stuff up, and it happens just like this. I still like walking through this overall process because I think it's important for me to just know exactly where all these numbers are coming from, and how it applies to my engagement that I'm working on right now. But walking through the examples is extremely important. So as we talked about, we're looking at the invested capital. So we're valuing the enterprise value of the entire company, the equity along with the debt. So of course, when we took a look at the discount rate from the equity side, do you remember what that discount rate was? So let's go back and take a look. So the total expected return on their equity was 20.5, and that's utilizing the build-up method. Now keep in mind, from a cap in, we didn't walk through the example of plugging in the numbers here for this, but in order for you to, I'm sorry, let me go back here. So we have the total expected return on the equity at 20.5. I just want to make sure that those numbers translated over here. So at 54.5, 45.5. Okay, so the expected return on equity is 20.6. So it's off by a decimal, 0.5 versus 0.6. That's where, and this is the number that I went back to refer to. Recall I stated that in order to calculate the WACC, you need the expected return on equity. So the expected return on equity comes from either utilizing the CAPM or the build-up method. In order to calculate the build-up method or the CAPM, you need to calculate what the expected return is. So essentially, they all tie in, but what the major difference is that with the WACC, you're doing the invested capital. You're taking care, you're doing the cost of debt, cost of equity as well, in order to calculate what your weighted average cost of capital is. So Colin, I think we should take a, 5-minute break here, unless you have another polling question.
Should we do one more real quick?
Sure, why don't we do a polling question, and then once they're all done with the polling question, why don't we take a water break, and then we'll come back and finish off the rest of this session.
There we go.
Okay.
So come back.
What time do you have?
I've got 5:02.
Okay. So what time would you want to come back?
Come back at the top of the hour, which is, it's almost going to be 1 o'clock here, but
okay. All right.
Top of the hour. That's easier for everybody.
That's easier for everyone. Okay, everyone. We'll come back right at the top of the hour.
Okay.
Back up. All right. I think I'm off for a couple of minutes, so I apologize to everyone. This is kind of like our second week back in our office building, and I went out to go to the kitchen and forgot my mask. And that's something that they are very strict on, making certain that everyone out in the hallways has a mask on. So I had to turn around and come back and grab that. So I apologize for that. All right. Are we all set, Colin?
Good to go.
All right, great. Welcome back, everyone. But before we jump back in, so I know we went through a lot of information, and I went through it probably very quickly. So I want to make sure that I went over things that are very clear to everyone. For me, it seems like it's pretty straightforward, but I never want to take the assumption that everybody understands everything that we went over. Some of the things are areas that, from a valuation analyst standpoint, you're going to utilize every day. Unless, as I mentioned to you, we utilize the income approach. What we do for our valuations, for the majority of our engagements, we do a lot of ESOPs where it's fair market value, and we do an income approach. And keep in mind, income approach is for those companies that are expected to continue to operate. So they're an ongoing concern. They're operating, generating income. So income approach, we use all three in our engagements, but we, for the most part, unless under different circumstances, we may use the market approach. We rarely use the asset approach. I have a couple of friends that work at different valuation places, and they do bankruptcy, so they use the asset approach pretty much like we use the income approach. And the market approach is utilized. It's a unique one. It depends on the size of the company and the industry that you're in, because you want to find the right amount of samples and amount of companies there to actually help you with those comps. So the income approach has been probably one of the areas that we work on a regular basis. So as you being, if this is an area that you're going to be focusing on in valuation, having a clear understanding of the build-up method, the WAG, the CAPM is extremely important. Which do you prefer to use is really your own preference, to degree of knowing which industry and the type of company that you're working with that is a better fit, so to speak. So we've, for the next 50 minutes or so, I guess we will say that we've covered the initial stages of understanding the income approach, of knowing that the most important thing in the income approach is the benefit stream, and then making sure that you find the right rate for the benefit stream, capitalization rate to the discount rate, or identify the right and appropriate benefit stream, I should say. And keep it in mind, we talked about that you have linear growth versus nonlinear growth. So we're going to talk about the two methods of the income approach now, where you have two primary methods. You have what's called the single period capitalization and the multi-period discounted cash flow period. We touched on this very briefly in the very beginning, distinguishing the types of companies that you are going to be evaluating. And the beautiful thing about valuation work, in my opinion, is that every day is something different. You're not going to be valuing a company this month, and just because they're in the same industry, they sell the exact same product, the valuation is going to be the same. And I share that with clients all the time. Every situation is going to be different, and that's what makes our lives exciting and different, because no two valuations are the same. They're all going to have something a little different. Even though they may be in the same industry, the same products, the management team is different, and how they run their business could be different. Every business has their own different ebbs and flows. So when you're valuing and utilizing an income approach, you can look at those two different methods. From a single period capitalization, you're forecasting your net cash flows one period forward. And just like you will do in the multi-period, you're going to discount using the adjusted capitalization rate, the cap rate, back to the present value. the multi-period, you're forecasting net cash flow instead of one period. Now you're forecasting out for several periods. So it's pretty much straightforward, right? It's kind of like the approaches. You have the asset approach, you're valuing assets. Market approach, you're valuing companies that are market. Income approach, you're valuing the income. So single period capitalization, multi-period discounted cash flow, multi-period, you're several periods out. So just understanding that distinction between the two. And remember, single period is more of a linear. Okay, you may have some bumps in the road along the way, not bumps in the road, but some volatility as far as the benefits, but it's linear. It's pretty much consistent. So if you're saying a 5% growth and you grow year over year over 1% growth rate, that's more of a linear. But if it's non-linear and you're expecting 5% here, down 3, up 7, those are non-linear. But you're forecasting out over several periods in order to apply that discount rate. So let's break down and take a look at the single period model. The formula for this is value equals net cash flow, or K with the discount rate minus the growth rate. So value equals the present value of the future net cash flow, excuse me. Net cash flow forecast in the next period. So remember, single period model, your forecast is out just one period. You have your discount rate and you have your long-term growth rate of cash flow. So this formula is referred to as a single period income capitalization model, or the capitalization of earnings approach. Now I will share with you, until I taught this class, I had never heard this being referred to as a single period income capitalization model. So I'm a big believer that this is a regional thing. So depending on where you're dialing in from, you may be accustomed to hearing it referred to as a single period income capitalization model. Here in the Northeast, especially here in New Jersey, referred to it as the capitalization of earnings approach. But if you hear it the other way, you know exactly what it's referring to. So the capitalization of earnings, we have equity value. Remember, we talked about the numerator and the denominator, right? Numerator is benefit stream, denominator is the rest of the return on your capital time invested. So looking at the numerator, we have net cash flows to the equity holder. So immediately, you know, we're not discussing the entire enterprise, the entire company. We're just focusing on, we're not focusing on the invested capital. We're just focusing on the equity holders and cash flows to the equity holder over the required rate of return, which is the cost of capital, which will give you the equity value. How do you calculate this? Let's start off with the net cash flows to equity. We touched on this very briefly on another slide, but this slide is a slide that you will see and you will work on in a number of different occasions. So when you're measuring the company value, keep in mind that that numerator captures the benefits, okay, of the capital that you're basically providing. The denominator captures the required rate of return for each capital provider. So when that numerator, if in fact that we were focusing on invested capital, that denominator you would be utilizing the WACC. But in this instance, we're not. We're just focusing on the equity side. So for this example, we have a normalized after-tax income of $500,000. Their estimated growth rate is 3%. So you would calculate the $500,000 times the growth rate, which would give you the projected after-tax income of $515,000. You add in your amortization or your depreciation. Let's say for this example of $100,000, this gives you your gross cash flow of $615,000. So if you recall, this is not where you're in. Now, if it was invested capital, we would add in the interest minus interest minus the taxes. But for here, we immediately go from your gross cash flow here to plus or minus changes in your net working capital. So we're going to subtract out $50,000 for your net working capital and your CapEx, subtracting out $150,000. Changes in the long-term debt, because it's now reoccurring. If you remember me stating that to you, you only apply changes in long-term debt if it's a reoccurring event. For this particular example, it's not. So therefore, there are no changes to long-term debt. So this stays. Plug in 0 here. And this leaves you with a net cash flow to equity of $415,000. So just to walk through this again, just to make sure everyone has it, you start off the company normalized after-tax income of $500,000. You have your industry growth rate of 3%, projected after-tax income $515,000. You add in your depreciation and amortization of $100,000, which equals your gross cash flow of $615,000. Then you make your adjustment for your net working capital and your CapEx. And this particular example is $200,000, $50,000 for net working capital, $150,000 for CapEx. There is no long-term debt. You have net cash flows to equity. So now that we have identified what our net cash flow is to equity, the next step is what? We have to find out what our cost of equity is. So how do we calculate this? Well, let's go back to our formulas that we were utilizing in the first part of our session. Start off with our risk-free rate of a 20-year treasury bond. So we'll use 4.5%. And it's noted here that this treasury bond is a Federal Reserve Treasury yield as of December 31, 2007. We have equity risk premium of 7.10. This is based off of the Stocks and Bonds Bills Inflation Valuation Edition 2007 yearbook. Industry risk premium 5.63, and this is for SIC code 633, which inside the valuation handbook, you can go right to your SIC codes, pull up what industry code 366 is, and you can plug in that number for your industry risk premium. Your size premium, I showed you on the grid as far as how you would calculate the size, the large, medium, small, or size of the overall company. This is at 6.2, and this is for a microcap 10th decile. For this particular example, we have specific company risk premium. Again, this is more of a judgment from the analyst at 4%. The discount rate after tax is 27.5%, 27.5%. The expected growth rate from the prior example, recall, was 3%. So 27.5, strike out the 3%, leaves you with 24.5%, which gives you your capitalization rate, and that's after tax. So I want to make sure that I want to emphasize something here. After tax. You're familiar with that phrase, always compare apples to apples and oranges to oranges. This is a very important part here. This is where a number of issues come up in valuation report, because they are taking this cap rate, which is an after tax. So if you're taking a CapEx of after tax, then your net cash flows, also everything else in your formula needs to be after tax as well. Because if you're not taking tax under consideration here, then that number actually looks a lot different. Your cap rate is going to look different. So you always want to make sure that you're comparing apples to apples. So your capitalization of earnings. You start with your net cash flow of $415,000. Where did that number come from? Let's go back and take a look here. Net cash flows to equity, we start off with the normalized after-tax income of $500,000. So you can see after-tax income. So you have your after-tax income. Your capitalization rate is after tax as well. And your net cash flows to equity is $415,000 after you made adjustments to your net working capital and your CapEx. Capitalization rate, 24.5. That's after tax, 24.5. Your implied value of equity is 1,693,878. How do we calculate this? Well, you take 415 times 24.5. Now you apply discounts. I'm not going to go into too much detail in regards to discounts because there's another section, it's on Friday, which will walk you through so you'll have a clear understanding of exactly what minority interest discounts are, what market, and the lack of marketability. But for this particular exercise, just understand that this is a company where you're valuing a percentage of interest in a particular company. So you're not valuing the entire company, you're valuing a percentage of it. So the minority interest discount that's applied to this is 20%. The minority marketable value of a lack of marketability discount here is 15%. So oftentimes I get the question, why are they separated? Why do we identify minority interest at 20% and the lack of marketability at 15%? Why don't we just add them together at 35%? Because they're not additive, they're multiplicative. So therefore, you separate the two and you take the 20%, which comes out to 338,776. You subtract this from the implied value of the equity. That comes to 1.355,102. 1,355,102. That identifies your minority market value, but you're not done there because of the mere fact that's your minority interest. Now, keeping in mind that this is a privately held company, so there's more than likely there's a marketability discount for lack of marketability. You're not able to sell this company just like that. It's not like if you had shares in Google, where you could take your share value, put it into the market, say, I want to sell it right at the market. Probably before you can hang up the phone, that transaction is already done with your financial advisor. Here it works differently. Here, there's probably not as a fluid market out there where people are waiting, knocking on your door to buy your business. It has to be marketed. And because of that, because there's not a fluid market, there's a discount that is applied. In this particular example, that discount is 15%. I will say this, and I said I wasn't going to go into too much detail, but I want to make sure that this is very clear, that the minority interest discount, 20%, the lack of marketability discount, 15%, that's not always constant. So oftentimes I'll run across old valuations of companies that we're valuing because we go back and we value companies, or let me rephrase that. When we establish a relationship with a company and we're providing a valuation, one of the things that I always ask for, when's the last time you had a valuation done? Sometimes they have, sometimes they haven't, but the ones that have, I always ask for a copy of the valuation because I would like to see it. And one of the things you'll start noticing is that some people will just arbitrarily place in a discount rate, 10% for lack of marketability, or 10% for a minority interest in a particular company. And there's no supporting documents, nothing to support that decision. We work with a business broker now that we've taken over that relationship because as I looked at a lot of their old valuations for this company, every single one of their companies had a discount rate of 10%. How is that possible? So, but for this example, and I don't want to go too far from that because you'll go over discounts and premiums later this week. But just know as you go into that class, you'll have a better understanding that they're not additive and it's not a bookshelf example. There's a lot that goes into applying those particular discounts. So for this particular example, you have a minority interest discount of 20, lack of marketability discount of 15%. So your minority market value is $1,000,003. You subtract your marketability discount of 23,000. Now it brings you down to your minority non-marketable value of 1.151 million. So we talked about it being a minority share. So how much of it is not the 100%? So how much of the company are we valuing? Well, in this particular instance, this shareholder owns 20% of the company that they are interested in being valued. So therefore, you plug in 20% of the 1.1 million, and their indicated fair market value now is 230,367. So we've applied their net cash flows to equity. We've applied their cap rate. We even went into a new subject of discounts. We applied the minority interest discount and the marketability and the lack of marketability discount and then applying the interest being value to come up with their indicated fair market value. So that's the single period method that we went over. But there's two different models. Now we're going to look at the multi-period model. And I also want to go back to something because I mentioned to you before that we do utilize the DCF for certain circumstances, but for the most part, we utilize capitalization of earnings, and this is something that we utilize on for the majority of our valuations. You're going to have some valuators that will say they never use capitalization earnings, and they'll share with you why they never use the capitalization earning, that they only use the DCF model. That's a preference. It depends on the type of valuation that you're working on. Some valuations, if you're dealing from a litigation standpoint, I encourage you to know what kind of approaches that the courts frown upon. Some do not like the DCF model. Some prefer the cost capitalization of earnings. It is a unique phenomenon when it comes to this, which is the reason why valuation is part art, part science, right? So you have the science part of this, but then the art of it is you, the valuator. And we can argue which weighs more than the other. I have my own opinions of doing this for X number of years now. And I'm pretty sure you have your opinions, and that's one that we could probably take offline and have a lengthy conversation about. But the art and the science part of it for the single period is no different than the multi-period, but now we're doing several series forward looking. So let's take a look at this example as well. Whereas we have the value, the present value, the future net cash flow. We have the net cash flow forecast at the time period N, okay? So this is your value. This is the net cash flow forecasted over an extended period of time. We have the discount rate, and then we have the present value factor at the time period, because we're forecasting now. So this is referred to as the discounted cash flow. So the theory is that discounted year by year cash flow into perpetuity. So it extends out. The application is the discounted year by year cash flows for the explicit forecast period, typically 5 years. Then you calculate a terminal value, and then it's discounted back. Here's the thing, that typically 5 years. Again, it depends. I'm in the camp of 5 years, and here's the reason why. If you're forecasting out further than that, then it gets to be really cloudy and judgmental at this point, because you're really applying your own subjectivity as far as the forecast period. 5 years is still pretty far out, to be honest, just for my taste. But it is one that you'll hear more of a 5 year than anything more than that. Anything less than that, I believe you may come across as you're not putting the time and effort into it. But 5 years, I think, is typically the area that you want to focus on. Also, keep in mind, hey, think about where we are right now. We're going through not an economic challenge. We're going through a health challenge, which caused an economic destruction in our markets, turning them upside down and changing the value of their company over the last. So we're in June now, 5 months. Whatever that growth or the value of that company was back in December is completely different for the most part. Not all industry, but for the most part, it's changed dramatically. So if you did some forecasting back in December for 2020, probably sitting down asking yourself, should I reach out to that client and talk about maybe we should redo our valuation? Because think about it, like I said, not all industries fall into this, but you're doing multi-period, even a single period. Your valuation doesn't hold a lot of weight right now because of the pandemic that we're in, and how long is it going to actually take companies to recover, if they ever recover. Your value is to really go back and sit down and have those conversations with business owners and redo your valuation or your forecasting for those. That's what we do. That's what we have in conversations with other evaluators in the NACBA community. Whether or not everyone does that, I don't know. There's always that discussion as, do I charge another fee for this or do I not? That's a personal preference at that point. But the forecasting is extremely important. Remember, it has to be realistic, it has to be reliable, and it has to be sustainable. Is that forecast sustainable? Is it realistic any longer? Is it reliable? No. So that's the reason why you want to sit down and go through this. So as you can see down at the bottom of the slide, you have the formula for calculating your value, net cash flow, discount rate, in order to come up with your terminal value. Okay, we have a poll check, and I'll let you guys check your poll. Make sure everyone's here so you can get your CE credit, and I'll drink some water. Okay, so terminal value, what is that? It sounds like something of a death sentence, right? Terminal value. Terminal value, you have your projected value of an investment, which is beyond the explicit forecast period. So terminal value is discounted and then is added to the present value of the forecast. So often what you find is that you have accounts for large percentage of that total present value, and that generally is highly sensitive to the underlying assumptions that you're working with. So those assumptions, which are the underlying component of the terminal value, what are they? Well, you have constant growth rates, you have constant capital structure, constant discount rates, constant margins and cash flows, and then you have economic equilibrium. So the forecast period must extend until the company has reached what is referred to as a stable growth period or the economic equilibrium. One of the things that I like to, in the context of litigation cases, this is a good tool to use in order to note a weakness in the valuation assumptions. Okay, I tend to view this as everything reverts back to the mean. Right? It was something that I learned in statistics years and years ago, is that it applies to forecasting. So that period, it extends out until it's reached a particular point of stable growth. Okay, so the growth is growing and growing and growing. The next thing you know, you see it starting to stabilize. That's when you know that you hit that economic equilibrium, because it's now kind of reverted back. Doesn't apply exactly, but it's how I view it. It reverts back to the mean. So there's two ways that one can calculate the terminal value. One is the Gordon growth model, and the other one is the exit multiple method. So what is the Gordon growth model? Again, this is one of those terminology you're probably familiar with from school. This is not a finance class, so I'm not going to break down every aspect of the Gordon growth model, but I will touch on each one of them, some of the important parts, I should say. So you have net cash flows, terminal yield times 1 plus the growth divided by K minus G. So you have the values of all the cash flows beyond that forecast period. It's essentially a capitalization approach. That's your Gordon constant growth model, or you refer to it as the Gordon growth model. Another way to calculate your terminal value, which is referred to as the exit multiple method. It is exactly how it sounds. It's dealing with different multiples. So you have EBITDA, which is a multiple, times EBITDA terminal year. Okay, and EBITDA, remember, that stands for earnings before interest, taxes, depreciation, and amortization. Then you have the PE multiple, price over earnings, multiple times the net income, net income terminal year. Then you have value enterprise or equity at the terminal value. That's the capital enterprise and equity holder, or the equity at the terminal year. So utilizing whichever one that you want, either the Gordon growth or the exit multiple, that is what you would use to calculate the terminal value when you're dealing with the discount cash flow. So let's take a look at how this would apply just in a graph format. So especially forecasted period, you see your forecast here. So you're from here to here. And this identifies your terminal year. So your terminal forecast net cash flow plus 1 plus G gives you your terminal forecast. Your discounted terminal value, 2 times 0, is your terminal value. You discount to your terminal here. So taking this slide, we're going to apply it to an actual income statement for a client that was a few years ago, as you can see, 2006, going back to 2006, starting at the valuations for 2009, went back to 2006. So as we look at this income statement, we have sales across the board. One of the things also, just to keep in mind, one of the things that we do on a regular basis, we make sure that all the numbers of everything that is inputted into their spreadsheets all make sense. Make sure the numbers aren't offline or there's a big discrepancy in anything that you have. So when you see sales, which is a reason why you like to have historical numbers for more than just 3 years to make sure there is no anomalies. There are no anomalies in the in their report. So for this particular company, they made assumption of 3% growth. You'll see their sales 24, 5, 6, 7. Cost of sales 72.75 of sales. Their gross profit at 27.25% of their sales, and operating expenses equates out to 16.9% of their sales. Their depreciation and amortization, $400,000 per year, consistent across. So you can see from their operating evidence, 2.5, 2.6, 2.7, and then 2.8. Taking out their depreciation each year gives them the operating income of 2.1, 2.2, 2.3, 2.4. This company had miscellaneous income expense, $16,400, and that was every single year. Interest expense of $6,000 reduction, and that was every single year. Does that happen for every single company? Not necessarily. Income before taxes. And then we get down to the normalized adjustments. So the normalized adjustments are applying to normalizing out what someone reports as as an example here, their comp. So as we all know that sometimes business owners, they use their business as a lifestyle business. So everything flows through that business, and their salaries could be $1 million, $500,000, whatever the case may be. But if you took a look at that business in the same industry and see what others or a public company or similar, how much their CEOs making doing the exact same job as that owner with that business, with that income, not income, would their salary be exactly the same or a little off? So excess of owner's compensation, in this example, the excess is over $110,000 per year, so that's applied. Non-operating expenses is an increase of $200,000 per year, which gives you total normalized adjustments as calculated here from adding these two together. Your normalized income before tax. Income tax is at 37%. And this is your normalized net income. So this was your income before taxes. This is your normalized net income after taxes at 1.379. So based on those calculations, now we have net cash flows to invested capital. Our normalized income before taxes. So if you recall, our normalized income before taxes in 2006 is 2.189, 2.2, 273, 2.358, 2.447, and 2.537. Remember when I said we go through and we want to make sure all the numbers look clean and there are no hiccups in the numbers? Well, that process still falls through after you do the data entry. Now, as you're calculating out the net cash flows to invested capital, you want to make sure that those numbers are matched to your forecast. So let's go back here. So we have normalized income before the tax of 2.189. So 2.189 before taxes. Normalized income before tax 2.189, so that matches. 2.273 matches. 238 matches, and 2.537. So this one comes out to 2.447. Oh, here we are, 210. Sorry. I was like, wait a minute, that's a problem there. All right, so the income tax is at 37%. Go through, do the calculations off here at 37% and gives you your normalized net income of 1.3, 1.4, 1.4, 1.5, and then 1.5 2010. Your cash flows adjustment plus your depreciation and amortization, we calculated, if you recall, $400,000 per year, plus interest expense after tax, less additions of working capital. So we didn't talk about working capital in there. So here we make our additions to working capital. So it's less $100,000 per year that they're adding back over to the capital. The capital expenditures is $300,000 per year. And this leaves you with your normalized net cash flow to invested capital. This is the money that you can invest back into overall, that identifies the growth of overall growth of this company and the strength of the company. And the bottom line is 1.4, 2006, 1.49, 1.5, 1.59, and then 1.6. So the basis for terminal value in this exercise in 2010 is 1,646,275. So 2010 net cash flows to invested capital, 103%, which is a growth factor. Net cash flows to invested capital with growth capitalization rate is 1,695,663. So again, one of the things that is extremely important is A, make sure that all your calculations match one another as you're going through. Your assumptions are in line with the business that you're working on as well as the industry in order to make sure that these are reasonable, sustainable projections that you're actually putting together for your net cash flows to invested capital. So your multi-period discount cash flow, taking a look at this sample company, you have your present value of your future cash flows and your terminal value. This is as of December 31, 2005. So our net cash flows to invested capital discount rate, utilizing a WACC, is 17%. And that present value formula is 1 divided by 1 plus the discount rate over the number of periods. So your NPV, net present value formula. So 2006, we have 1,442,000. 2007, 1,409,000. 154, 1596, 1646. Where did these numbers come from? Go back and take a look at slide here. So you got 2.4, actually, I'm sorry, 1.42. So this is your normalized net cash flows to invested capital. 1.491, 1.41, 1.493, and 1.646 in 2010. So those numbers all match. Now let's take a look at your discount. Applies the discount to your net present value here. This is 1.23218 961 849 749. Your net present value to future cash flows is 4,882,000, which is adding from 2006 to 2010. Your net cash flows to invested capitalization rate next year is 14%. So your 2010, if you go back, your 46,275, your growth factor, which we applied here, gives you a cash flow with growth of 1,695,750. Your cap rate of 14% applies for your terminal value now of 12,086,244. This leaves you with your net present value of 9,444,823. So how does terminal value affect the total value? Well, it affects it in a number of different ways, but probably the one that is very critical is that the terminal value usually accounts for a large percentage of the overall reduction. Okay, so the special care should be taken when you're determining the terminal value. So if you go back and you take a look at this particular example, remember, our net present value forecasted cash flow was 4,882,000. Okay, and just make sure those numbers are 4,482,000. So right here, your net present value of future cash flows was 4,882,000, and this was adding from 2006 to 2010. Our net present value terminal value was 4,562,799. This is our terminal value. So our net present value forecasted cash flow represents 51.7% of the total value. Our terminal value represents 48.3%. Our total value of the company is 9,444,000. If you recall here, this is our net present value of the business. So it is a large percentage of that overall valuation. So when you're calculating that terminal value, it is extremely important for you to make sure that your calculations are accurate and as precise as they possibly can be, because that can throw your entire valuation out of whack. That's a significant chunk of the overall valuation of 48%. So at this point, Colin, we are at the end of our presentation here. I didn't have any questions, so we kind of went through this pretty quickly. So we have about 8 minutes or so. So this would be a good time to ask any questions, or if you had any questions pertaining to anything that you talked about on Monday and Tuesday, perhaps I will be able to address those for you as well.
Yeah, this is the time to do it. You can just put something in the Q&A if you prefer, or we'll even take something in the chat, either one.
And keep in mind that my email address, I think you all should have it. It's Stephen with a ph.white@opgbv.com. Feel free to email me if you prefer not to address a question, or if you hadn't thought about something right now. But I'm always open to address and answer any particular question. But there is something, well, if you are thinking, look up the questions. I do want to go back here. What about this during break? And I probably should have pulled my book out, and it would have been helpful to you. So here's why this is extremely important, and I spent a little bit of time going over this and explaining to you about how Morningstar was acquired by Dolphin Phelps, and then Dolphin Phelps used to issue out a book every year, The Cost of Capital, and they no longer do that. They actually, everything is web-based right now. But here's the thing. So if you take a look at this SBBI Valuation Edition, this is from 2002. Do you think you'll ever have a situation where you'll be asked to value a company from a prior valuation? Probably will. I know that we have. And we did this even before I started this company. We would go back and do a valuation because someone questioned the valuation X number of years. And they wanted to know what the value of the company was at that particular time. Where are you going to get that information? Well, could you just pull it up on Duff and Phelps? You probably could, but it's also one of the things where you can go back in history and pull these books. And as I pull the book off the shelf, right, look at the information within those books, just so for your own edification and knowing where those numbers have come from. Is it possible they can make an error in the Duff calculator or the BVR calculator or whatever software that's out there creating those, and how far back do they go? It's a possibility. I feel more confident by going to this particular resource for events such as this. Duff Phelps, you can place in there what year you are focusing on for estimating this cost of capital, and you can pull that information out. But I think it's a fantastic read for you to go back and just observe and look at the different trends of the market at that point. And if you're looking at the CAPM model and utilizing the volatility of understanding beta and how beta works, and you can see there's a distinct difference between using the build-up method versus using CAPM, obviously, because of the mere fact that you're now focusing more on the market itself. Because of that, I personally like using CAPM because it does take out a lot of the subjectivity. You are focusing more on the market. It's something that I focus my attention on coming through school, whereas I have someone on a team that loves working on the build-up method. Now, we discuss all of this before we actually put the valuation together, which one would be more appropriate for this particular case. And I'm not saying just because I'm there, I had the final vote. I don't always agree that it should be CAPM. Sometimes it is better suited for the build-up, even though CAPM is probably one that I focus my attention on more so. So wherever it is that you are you'll have those distinctions of which one that you actually think you'll be a better suited. And then there's also Famafinch also is another way to create the discount rate, come up with the discount rate as well. So there's a number of different theories, philosophies out there on how you calculate your discount rate. The ones that are more popular, like I said, you have your build-up method. There's a lot of subjectivity. Some courts, they like this because it's a little easier to understand than working on the capital asset pricing model. If you utilize these, you'll see that they still tie into one another. You still need to know what your expected return is. You still need to know what the risk-free rate is. The difference is understand how to calculate the beta or how to derive the beta from your T in order to have your equity risk premium for the market. So still no questions.
So maybe can I ask a question?
Sure.
Okay. So I think, and I've heard this before, but just to kind of clarify, regardless of which approach you use, it's more important that you can justify why you use that method. That's
like the that should be the one thing that you have up on your office door always. Whatever decision that you make certain that you have documents to support your decision and why you chose to use this. As I stated to you, we utilize the income approach. We observe all three approaches. We may not use the all three. Oftentimes we don't. We defer to the income approach, but there's a reason why we rejected those other approaches. So you have to have enough information to support it. And even then, when you decide I'm going to go with the income approach. So why did you use the capitalization of earnings versus the DCF model? Well, there was a reason why we did this, and you want to have built into your valuation report supporting information to discern why you chose to work with that particular model versus the DCF. And if you did do the DCF, okay, because of the mere fact that you're either focusing on a single period method or you're using the multi-period method, you want to make sure that if you feel as though your business is more in line to be more of a linear, you want to build that into your overall report. You want to be able to explain why and justify that particular situation. Oftentimes, I'll read court cases where the valuator was thrown out because they chose a particular approach or they chose a particular method but didn't have anything to support it. All their numbers were accurate. If you go through the report, it's astounding. You go through the report, all the numbers were accurate. The question that was brought up, why did you use this particular approach? And it wasn't included anywhere in their evaluation and in the report. So for them to have that conversation and explain it, you can do that. But they also like to see it built into your overall report to justify why you did certain things. Because technically they could be saying that you're speaking on the fly, you don't have anything to support it there. But from our perspective, going through the report, yes, the numbers were accurate, but they just didn't have anything in it to support it. So Colin, that is a number one question that you should always take into consideration, making sure you have the things to support whatever decision that you have. And that even goes back to when you're doing your due diligence of the company, making sure that you revenue ruling 5960 should be plastered there in your office, and making sure that you hit every single bucket there, even if it's a company that you know that doesn't distribute dividends or they've never been involved in a transaction. Those are still questions that you need to ask, and you need to make certain that you apply those in your valuation report as well. Those things are just as important as determining which approach that you use, which method that you're using, how do you identify the benefit stream. Everything is tied together. It's like you're building something. You start off with your foundation, then you get to that point, which we're not at yet at the epics of it. We're right now just choosing the right approach to use, and then subsets into identifying the appropriate methods to use. But there's so much more that goes into evaluation, and we'll talk about discounts. You'll talk about sanity checks that you'll learn about, and the market approach. How do you use the market approach, or understanding the methods that you will use in an asset approach? All those things are extremely important. It's a lot of moving parts, but everything that you do, make certain you have something to support it. Even in your economic information, you made the determination on economics. How did you come up with that? Where did you get that information from? What documents do you have to support your decision on this, or compensation? Again, it's all based off on supporting documentation. Yes, it is your judgment. Yes, that is the art side of it, but even your art has to have support, if that makes any sense.
Fantastic. Any other questions? If not, we are going to head into the afternoon, if that's where you're at. Have a great day. And of course, we still have 2 more days, right?
That's right. You have 2 more exciting days of the wonderful world of business valuation. I appreciate all your time today. You didn't ask any questions, so I'm assuming I did a great job. Hopefully that is the case. But I appreciate your attention over the last 2 hours, and enjoy the rest of your day.
See you later.